Hey, it's Jim, and this is level 2 of the CFA program, the topic on equity valuation and the learning module on private company valuation. The Institute is very clear in this first paragraph of this learning module in which it tells us something like, hey, you know what? We spent a whole bunch of time on previous learning modules on how to value any kind of a business, in particular, a publicly traded company. But this module is going to use all of that material that we focused on recently, but we're going to have to make some adjustments. And that's pretty much what we're going to do here. So pay attention to the new definitions and pay attention to the adjustments from our public company valuation learning modules to this one here. Now, I'm guessing you've noticed that this is a relatively long learning module, and so you're not surprised that we have many LOSs. But if you read some of those bolded words, we've done this before, right? Cash flow estimation, CAPM, build-up approach, income market-asset-based approaches, calculate using income and market-based methods. So we've done all that stuff before, but the key LOSs are that first one, right? To find out the differences between public and private valuation. And then look down at that, what is that, the fourth one, require the adjustments. So pay attention to those adjustments. And the good news is that we've done lots of this stuff before. All right, this first LOS is a pretty simple one here, contrast. So what are the differences between private companies and public companies? Of course, private companies, they're probably smaller. They're probably less mature. They're probably run and operated by either the founder or the founding family members, or they still hold a substantial and probably, a majority ownership. Probably don't have a whole lot of information about the business and its model. The shareholders, the owners in these private companies, they're in it for the long term. We have a local business in here, and the advertisement is, hey, we've been around since 1946, and so it's the same family for however many years that is. So longer term perspective. And then in the private company valuation, you have to worry I don't want to say you have to worry more about tax management, but it becomes more important because the tax liabilities are difficult to separate the business from the individual. Public companies, we know all those things over there, right? Tons and tons of shareholders out there traded on the floor of the New York Stock Exchange. All we need to do is type in Johnson & Johnson, and we get tons and tons of information and financial data on that particular firm. Here's an even better slide about the differences, and these might even be better exam questions. So less liquidity for those private companies, right? That makes perfect sense. Concentration, and then there's potential restriction on the sale of shares, which you have, in some public companies, but not nearly to the degree in the private companies. Now, there's a section in the learning module that asks the question, why are we doing this? Why do we care about evaluating and valuing a privately held company? Well, we're going to do this for a variety of reasons. So that's why we have the three triangles. That's a rectangle. Rectangular boxes. We could be an analyst for a financial institution, and this private business comes to us and says, hey, we want to borrow $10 million. So we're going to have to figure out what that value is, what is the default probability, and all those kinds of good things. We're going to need this for companies that are growing and look for an initial public offering. Private firms, they merge and they acquire and they go bankrupt. And then, of course, we need to figure out what that compensation is to the executives of this private company. Remember, these are probably the owners, maybe even the founders. And so they may say something like, I get a salary of $100,000 a year, but there's $1 million that goes into my retirement. So share-based compensation and retirement stuff, that's probably important. Compliance related for taxes, for financial reporting, and then litigation if we have any kind of a dispute. Notice down the bottom right there, divorce settlements. Wouldn't it be awesome if we all could say I do and stay I did for the rest of our lives? But of course that doesn't happen. So you have to value a company when there's a divorce and then that ownership splits and then one spouse says, you know what, I want out, et cetera, et cetera. All right, so private company valuation areas of focus. What do we know? Those first two sound like stuff that we've done, right? Cash flow, earnings estimates, but we'll have to make an adjustment. What's the second one? How about discount rates, expected rates of return, required rates of return? We'll talk about the capital asset pricing model, but then we need to make an adjustment. And then there are going to be some discounts and premiums in there in terms of marketability and control. We'll do that in just a little bit. So let's go back to Modigliani and Miller from 1958, what they taught us in that awesome paper on capital structure. They taught us that the value of the firm is equal to the quality of the assets and the weighted average cost of capital. You can put that into a really super simple formula, but what these normalized earnings look like is something exactly what Modigliani and Miller suggested all those years ago. What we're going to do is take some kind of reported earnings and then we're going to make adjustments. Now, these adjustments are similar to the adjustments that we see in the financial statements for Johnson & Johnson or Nike, but they're going to be some unusual items that relate to a family-owned business. And so when we sum those two, we get something that we're going to call normalized earnings. And that normalized earnings sounds an awful lot like, and it looks an awful lot like, hey, you know what? This is what's reported, but we have all this stuff going on inside of the family that is probably not going to be repeated. When I first got into teaching, I had a colleague, I don't want to call him a friend, I had a colleague whose parents owned a business, and this particular son was quite a horse player, and he would dip into the family's cash register to go to the racetrack. And I thought, man, oh man, boy, why don't my parents own a business so I could have a flow of funds like that? But anyway, you get the sense that that's probably not going to happen at Johnson & Johnson, so we have to make adjustments for those kinds of things. Here's a little bit more specifics and formal reasons for adjustments: tax-motivated expenses, above market compensation for family members, loans, high owner compensation levels, personal expenses is what I was talking about just a minute ago. And so lots of time, those reported earnings, they could be super high or they could be super low. So we need to make some adjustments related to those bolded items there. How about real estate? Oh boy, market rental charges. We need to worry about that. I mean, think about it. If family owns a business and they own a bunch of land, and back there's a house on the back of the property, and one of the children lives there rent free. So if we're going to value that, do we add a $0 of rental income into that? Because if we take over this company, or if it's acquired, or if it declares bankruptcy, or there's value, there's income potential in that house back there, whether it's for income or capital gain, whatever it is. We need to worry about depreciation as always. We need to worry about lease rates. And so remember all that stuff that we did. And we had a really good learning module back in level 1 on real estate and infrastructure. So all that stuff that you learned back in level 1, and it flows exactly up into level 2 as well. Other adjustments, inventory accounting methods. Of course, if you're a private company, you're probably going to get audited, and you're going to have a public accountant come in and audit your inventory. But you could use almost any kind of inventory accounting method that you want, and so there's probably some adjustments to get to weighted average or LIFO or whatever other kind of inventory valuation method that is appropriate. Same thing with depreciation. Same thing with capitalization, same thing with intangible assets. Now let's go ahead and continue to focus on some of these adjustments. I think this is a really good potential exam question. Look at the circle points that we have above. And so I can see the Institute asking a question that would say, which of the following would require some kind of an adjustment for cash flow estimation? And one of those answers could be any of the teardrop points that we have below. differences in cash flow estimates, uncertainty about future operations. And I like that scenario analysis. For those of you who listen to my videos, you'll know that I love scenario analysis. I want you to just think about a big old Excel spreadsheet and changing one or a handful of input variables to see what happens to the output. I mean, a lot of times the output is going to be net present value if we're talking about capital budgeting. Here, the output might be something like, oh, it could be normalized earnings. It could be cash flow. It could be enterprise value. It could be almost anything that we want. So keep in mind that scenario analysis that we've discussed in all three levels applies here. Life cycle stages, I imagine the Institute could say in one of those sentences in the question stem, something like, hey, this company looks like it's going to be going into bankruptcy proceedings soon. Maybe it'll say something like, hey, the debt equity ratio used to be 0.2, now it's 100. So you might have to determine or infer if there's an increase in the probability of bankruptcy, or an initial public offering, or so remember those life cycle stages. Sometime the Institute might say something like, hey, this is just a regular old firm. They've been operating for 50 years. They make a bunch of money. They're going to operate for another 50 years. So then you don't have to worry about bankruptcy. And then you think about, okay, are we ready for an IPO? The Institute will probably give you a signal in there. Management biases, of course, in all this is human nature, right? We're all going to overestimate or inflate our value. But what the Institute emphasizes inside of this learning module is this concept of goodwill, right? So here's an intangible asset. How does this arise when there's some kind of an acquisition? And so the management, when it takes over another company, says, you know what, we can do that. We can double or triple or quintuple or whatever that word is. So we need to worry about impairment of goodwill to reduce that on the cash flow estimation. And then capital structure changes. A lot of times in these private firms, they'll have bank loans as part of their capital structure, and that might be it. Maybe there's some private debt out there that it gets from a hedge fund or wherever it might be. So the key thing, and this is an emphasis in the reading, is, all right, we have the observable capital structure, but that might be substantially off from an optimal capital structure. So then what capital structure weights do you use? Do you use the current ones? Do you use the optimal ones? Or you use something in the middle? I'll address that point when we get to an example at the end of this slide deck. All right, how about the next step here? Discount rate estimation elements. All right, so what are we worried about? What we can do typically is we can just say, you know what, let's just use the capital asset pricing model, and whatever that number is, that's what we'll use. However, we're probably going to have some kind of a size premium. We know this from lots and lots of academic research that says that smaller firms tend to outperform larger firms, not least of which is because they probably have a little bit extra risk. There's probably some lack of transparency in financial statements. So all that stuff that we learn in our corporate conversations applies here. Of course, debt is always cheaper than equity. Boy, did I just really say that? Don't repeat that. It's almost always cheaper than equity. And so what happens here is that the more founding members, the more members and family members and friends that supply equity capital, we're going to have a higher cost of capital and a higher required return on equity. So what then that translates into, and look at that second bullet point, this is a great exam question, is that that higher operating risk is going to imply a higher marginal cost of debt. That makes perfect sense. Now here's this example where we're comparing and investigating the potential for an acquisition. And so what we need to make sure that let me go back here, we did this scenario analysis. All right, so we're inside of this scenario analysis. We're thinking about taking over another company. What kind of discount rate do we use? What kind of a weighted average cost of capital do we use? Well, do we use the target firm's cost of capital? Do we use the acquiring firm's cost of capital? Or do we use some kind of a mixture of the two? So there's the answer. It must be consistent with the cash flows. Now, there's this concept of projection risk where we're saying something like, all right, if all of this happens, what is going to be the result? And the result is that, boy, we have lower available information from these private firms. They're inexperienced in forecasting, not like the Johnson & Johnson executive team. So when we look at those reports, we have to say something like, you know what, if we come up with a discount rate based on all that stuff above of, let's say, 10%, we're going to have to add some kind of a projection risk premium because we don't know how reliable, and we don't know how accurate all that information that has been made available to us. So we're going to make another adjustment there. And then a life cycle stage adjustment. That makes perfect sense. Well, there's my favorite model up there. You guys know this from listening to me over and over again. Back in level 1, now in level 2. So you'll hear about it in level 3. Capital asset pricing model, where we just we take the systematic risk of a public company and we adjust it for market rates of return and the risk-free rate of interest. Notice what we have there. It's generally inappropriate. Now, I'm fascinated that in the reading, in the examples inside of the learning module, the Institute, they like to give you the CAPM required return on equity. And so it's probably not going to be used. However, what we're going to do is use this expanded capital asset pricing model. So we're going to use regular old William Sharpe capital asset pricing model, and we're going to add a small stock premium, which we talked about in that previous slide, and a company-specific risk premium, which we also talked about in that previous slide. Now, what I would prefer, this is just my own editorialization here, I would prefer that we just use regular old CAPM, but we embed the small stock premium, the company-specific risk premium, and any other risk premiums that we come up with. We embed that in the beta, the measure of systematic risk for this privately held company. Of course, the problem with that is how do you do it? I mean, there are ways to do it, but this way here is extremely easy to test, and so the Institute is probably going to use that expanded capital asset pricing model. Now, also remember, we can go back to level 1 where we did this building blocks approach. Here we call it the build up approach. So we just start with a risk-free rate. So of course that makes perfect sense. And then we just add a bunch of premiums. We can add an equity, we can add a small, we can add a company, we can add an industry, we can add a maturity, we can add a default risk premium. All those premiums that we talked about back in level 1, we can go ahead and add those. Now, of course, some of those that I just gave you are summarized by that equity risk premium. Problem, of course, is how do you compute those things? Well, that's the way life works. You get a bunch of data out there and you try to figure out what's appropriate. But that's why the Institute loves this mosaic theory, because what we're learning is that it's part science, which capital asset pricing model is science, but then it's a large part of artistry where we, try to take our paintbrush and we try to figure out, do we want to do the red over there and the purple over there and do whatever it is. So here's a really simple example. So we're given a question stem with a bunch of premiums and risk-free rates up at the top. So there we're going to just use our regular old capital asset pricing model. We get, 15.31%. Then we can expand that. We can add 5 and 188 to that capital asset pricing model to get 22, or we can use the build-up approach to get 17. And so please know that if we're trying to value a company, remember you're going to use your financial calculator. So you're putting a bunch of cash flows in there, right? You know how to do cash flow 1 and cash flow 2, cash flow 3. We'll do that later on in this slide deck. So you're doing all those cash flows, and then your financial calculator asks you to hit an interest rate, right? So if you put 15 in there, you get an answer. If you put 22 in there, you get a different answer. If you put 17 in there, you get yet another answer. So depending on which model you pick, using the discount rate is going to have a substantial impact on the estimate of the value of the firm. So let me just quickly go back to Modigliani and Miller. What do they say? Value of the firm is based on the quality of the assets. So that means the ability of the firm to generate sustainable cash flows. And then the weighted average cost of capital. So think about how important this is in the denominator of that model. Now, 2 quick adjustments that we'll have to make. A discount for the lack of control. There's a good old formula for you to remember. That's just a regular old time value of money. equation, all we're going to do is say something like, you know what, if we want to take over a company, a private company, and if we're going to take it over and we're not going to have control, maybe we only buy 30%, maybe we can only buy 40%, maybe we can only buy 10%. So this control premium, so this is the absence of some or all control. So we might even be able to buy 60% of it, but maybe there's some other outstanding shares. Maybe there are private shares, maybe there are Class B shares, maybe there are options out there that the founders continue to have. So we need to take a discount. And so there's the equation there. This is pretty simple, but I want you to go down to the two gray boxes there. These are really good exam questions, right? Look at the LOS. It's explain and evaluate. We don't have to calculate yet. We're going to do that at the end where we have to calculate, but these are really good, kind of descriptive or definitional questions. So the discount for lack of control is going to be higher when there are no dividends and when there's no IPO on the horizon. The discount will be lower when they're actively seeking an IPO. That should make perfect sense. And then the private company is a strategic sale, meaning that we're going to take over it and we're going to take control. Here's just a super simple math question. If we have a control premium of 15%, which will be given to you in the problem. So there's that discount of 13%. The next one is a lack of marketability discount. This is a little bit more simple mathematics. All you do is just take 1 minus that marketability discount. This, of course, reflects the absence of marketability, meaning that there's not a lot of liquidity, not a lot of buyers out there, non-controlling interest. Here's another similar kind of inputs that might make good potential exam questions. So you can take a look at factors that increase that discount. Those make perfect sense there. Concentration of ownership, higher risk. Factors that decrease, there we go, payment of dividends, greater liquidity, potential buyers, and duration. Let's do a super simple question here. Look up in the blue box. There's the estimated value of the equity interest with both the control and the marketability discounts in there. So if we have 15% and 11%, you just do the compounding effect there, so you get 24.3%. All right, we're going to spend the rest of the time here on looking at several approaches. We're going to do the income approach. What does this sound an awful lot like what we've done before? Estimate those future cash flows, find an appropriate discount rate, and then compute the present value. There we go. Present value and price, present value and market value, they all mean the same thing. Market approach, we're going to go ahead and look at companies that are very similar to the private company and take a look at multiples. And we're going to take a look at sales of similar assets. This is mostly appropriate for mature and stable companies. And then the asset-based approach, we're going to go ahead and take a look at the value of the company's net assets, right? Asset-based approach, we're going to concentrate on the left-hand side of the balance sheet. One really, really good exam question. If I were making up a test, I would look at the last 3 arrow points. Absolute valuation, skip down to the bottom, absolute valuation, and then market approach is a relative valuation. I think I give you guys hints over the years and these slides and these recordings about stupid ways to remember things. Look, you're doing the income approach and the asset approach. They both begin with a vowel, and so those are absolute, which begins with a vowel. Market approach is a consonant, relative, so there you go. You don't even have to worry about memorizing. You can have one of those stupid gym tricks so that you can answer the question correctly. All right, how about some other factors when we're selecting these valuation approaches? So let me just go back here quickly, right? We can use income, we can use market, we can use asset-based approach. And we're probably going to get 3 different numbers if we do this for one privately held company. So the question then becomes, what's appropriate? Let's worry about the life cycle. Let's worry about size. Let's worry about the nature of operations. So think about the size of the company and the stage. That is more of a micro analysis. So we would be doing, kind of like a bottom up, size of the company, stages. But then the nature of operations, that's almost an industry analysis, or that's kind of the middle. Maybe you could take it up to a macro analysis. So the nature of the operations, it depends on what's the competition look like, what industry. What did I say earlier? I have a local business that's a baker. And so, this guy's been making donuts and cakes for 100 years. What's the publicly available competition, and how does that relate to? So, think about it. There's tons and tons of information on bakeries and bakers that are publicly held. And so you might want to use something that's appropriate for the nature of that operations. All right, we know all about this. Free cash flow to the firm. We start with some estimate of earnings. We're going to call it normalized earnings from one of those previous slides. We'll go ahead and take out interest expense. That makes perfect sense. We're going to go ahead and estimate income taxes. We'll add back our depreciation, which is a non-cash expense. Now, the Institute doesn't emphasize that, but remember, we also have amortization and depletion to add back. But since the Institute doesn't consider that inside of this learning module, but I just add it to my commentary so that you have it in the back of your mind. Don't forget about those other non-cash expenses. And then subtract a provision for working capital and long-term expenditure. So I want you to think about this. Free cash flow to the firm. This is how I define this to my students. I say, look, it's the amount of cash remaining after all expenses have been paid, including things like all of the operating expenses, then the interest expenses, then the tax expenses, and depreciation expenses, right? And then after all expenses have been paid and all investments have been made. So that second part, the all investments have been made, that's that final block point over on the right. So the provision for capital expenditures, so those are long-term investments, and working capital expenditures, those are short-term investments. So I always tell my students, and you may have heard me say this in previous recordings, think of this determination of free cash flow to the firm as cash flow that's available after we make long-term investments and short-term investments. Now, of course, we make some other adjustments here. What is the free cash flow to the equity? Look at the blue box down at the bottom. We start with that end number at the end, and then we subtract out the subsidy that we get from the after-tax interest, and then we add in any new borrowing or repayment of debt. Free cash flow to the firm, free cash flow to equity. We had an entire learning module on that recently. All right, so what we're going to do here is break this down into two parts. We're going to take the present value of the expected future cash flows. Look at that left circle blue point. And all that is going to be a handful of years. We're going to say something like, hey, you know what? Let's go ahead. We're pretty certain that we're going to be able to accurately and reasonably estimate cash flows in year 1, 2, and 3. All right. But then after that, we're not quite sure, so we're going to go ahead and substitute what we call terminal value, which would be the cash flows from year 4 all the way to infinity. So we're going to take the combination of the present value of what we reasonably know and then the present value of what we expect to get once we hit that long-term sustainable growth rate. And that's going to be the value of the firm. And we'll do a math problem here in just a little bit. All right, so this goes back to exactly Modigliani and Miller, 1958. What did I say to you? Modigliani and Miller taught us that the value of the firm depends on two variables. The ability of the firm to generate sustainable cash flow, right? Well, there you go. Free cash flow to the firm in the numerator. I always refer to it as the quality of the asset. Think about it in the following terms. Quality of the asset is sustainable revenues minus minimizing operating expenses, and plus all that other stuff that we talked about in that previous slide. Think about it as the quality of the asset. Make something for pennies, sell it for dollars. Think about the brand name. Think about all those really cool things that we talk about in those corporate finance learning modules. So that goes in the numerator, and then in the denominator, because it's the free cash flow to the firm, which includes the top right and the bottom right of the balance sheet, we need to worry about the weighted average cost of capital. And then we're going to subtract out that sustainable growth rate of the free cash flow to the firm. Now, on the other hand, what we can do is we can compute the value of the equity. So look up top, that's value to the firm. Now we have value to the equity, and we're going to strip away the bonds, and we're just going to say, what about the free cash flow to equity in the numerator? And then we're going to do that required return on equity. So there's the lowercase r in the denominator, which could be, now remember, what did we have on that slide? Probably not appropriate, but that r could be the capital asset pricing model. And then make sure that you put the growth rate down there in the free cash flows to the equity. All right, so let's just do a super quick example there. We're given free cash flow to the firm, which is currently 30 million. So we need to make sure that we compound that out, because in the numerator, here, let me go back here. Remember, that's free cash flow to the firm time period 1. So that 30 million given to us in the problem is free cash flow to the firm time period 0. So we'll go ahead and multiply that by the 3.5% growth rate. So there's our numerator. So whatever 30 times 1.035 is, that's our expectations for free cash flow 1 year from today. And we're just going to go ahead and divide that by the 12% weighted average cost of capital minus the 3.5%. So we get the free cash flow to the firm of $365 million. What we can do then is use just really the fundamental accounting equation and take out the 60 million in debt to get the value of the equity of 305 million. You see how easy that way is versus doing it down there in the bottom. If you do at the bottom, you need to make, here, let me go back. You need to make all of the adjustments that we're doing down here at the bottom. So think that the Institute could give you, they could ask you this question in one of two ways. If it gives you the market value of the debt, you go ahead and give the Institute a high five and say, yeah, this is super simple. Or if the Institute gives you free cash flow to the firm and free cash flow to equity, well, then you might have to back into the market value of the debt. All right, let's go ahead and work through a relatively comprehensive question. Now, the Institute is very likely to give you a table that looks, pretty similar to what we're showing here. A couple of interesting things. Notice that down the right-hand column, there are some dollar amounts and there are percentages. So let's make sure you understand the difference between all of those. So look at the second row. We have 20 million in sales today, right? So what we're doing here is we're going to use that as a base figure and estimate year 1 and 2 and 3 and 4 and 5, right, all the way out to infinity. We'll go ahead and use the net profit margin of 15% in that first row. So fixed capital investment in year 1, today is $1 million, and then depreciation today is $2 million. Now, this is really an interesting thing. The way the Institute provides this in the examples in this learning module is the Institute gives a dollar amount of depreciation, like we do here, of $2 million. And then there are different ways to do this. The way we do it here in this example is that we're just going to take 10% of sales, assuming that the sales is a function of the assets that we invest in. So we'll just do 10% of sales. So I mentioned that so that when you get to this problem on the exam, that you don't miss the depreciation, because if you miss one of these, you get the wrong answer when you have to calculate. So think about this way: the Institute can give you depreciation in a dollar amount. It can give you depreciation as a percentage. So there's working capital as a percent of sales. There's the tax rate. There's interest expense as a percent of debt, 5 million. Now, skip down to the bottom. So there's the growth rate for the next 2 years. So that's 8%. So we're going to have, here's year 0, and then we got 1, and then year 2. So that we're having a higher growth rate. So what we're going to do is we're going to go ahead and compute and estimate the free cash flow in year 1 and year 2. And then we're going to add the terminal value at the end of year 2 based on that long-term constant growth rate. So think about this. We're going to grow at 8% for 2 years, but because of things like competition and maybe some other factors out there, we can't sustain it. So after year 2, we're going to go ahead and revert back to what Modigliani and Miller call, some kind of a normal growth rate. Just think of it as a constant long-term growth rate from year 2 all the way out to infinity. And so this is identical to what we did in a previous learning module where we had the 2-stage Gordon growth model. You'll see that as I go through this next slide. So there we go. Let's go ahead and start with the 20 million in sales. So we have an 8% growth rate to year 1, 8% growth rate to year 2. So that's pretty obvious, right? We'll take the net income using that. Let me just go back here so you guys see that. There's the net profit margin, 15%. Take 15% of that, and then the depreciation. So we start with the 2 million. And the Institute might give you, they might just say, use straight line depreciation. And if they give you 2 million, then you would just put 2 million, right across those time periods, right? All right, after tax expense, there's 35, 38, and 41. Fixed capital is 5%. Working capital is 5.5%. And so you get down at the bottom. So the free cash flow to the firm is going to be 3.25 today, but the more important are the estimates for time period 1 and time period 2. So we get the 351 in time period 1 and then the 379 in time period 2. All right, so what we're going to do is just assume that this is our high growth period. This is our 8% growth period, and we expect to have free cash flow to the firm of 351 in year 1 and 379 in year 2. So all we're going to do is take the present value of those two things. So look down at the bottom. We're going to take the value of the firm is the present value of the 351, and we'll divide that by the 15%. Where do we get this back here? Weighted average cost of capital during the high growth phase, there's 15%. And then we're going to add the 3.79. So look at after the plus sign, you see the 3.79. Now forget about the plus sign in the numerator there of the 4337. Forget about that for just a second. So we're taking the 351 divided by 1.15. Then we're going to take the 379 divided by the 1.15 squared, right? So that's the discount rate during that high growth period. So you just take those two. Now, conveniently, the terminal value occurs at the end of year 2. So let's go ahead and compute the terminal value. We're just going to take that 379, multiply it by 1.03, the normal growth rate. So when you do the 379 times the 1.03, that's the estimate of the free cash flow at the end of year 3. So we need to take the present value of that using the Myron-Gordon growth model. Remember this dividend discount model. And so here, let's go back here. What do we have? The weighted average cost of capital during the mature phase. So there's the 12%. So we do the 12% minus the 3%. That's the normal growth rate. So we get a terminal value of 43.37. Now, I want you to think about it like this. I always teach my students that when you compute that terminal value, think about that as the expected future selling value of the business. So what are we going to do? We're going to generate 351 in year 1. We're going to generate 379 in year 2, and then we're going to immediately sell the business for 43.37. Don't worry about who we're going to sell it to. We're just assuming that we're going to sell it. That's why we call it terminal value, right? Terminal means the end. So let's go down to the very bottom. What are we doing? Value of the firm. We get 351 divided by the 115. We're going to do the 379 divided by the 115 squared, and we're going to add the terminal value of 43.37 divided by the 115 squared, and we get the value of the firm. Voila, as my mother used to say to me. There it is, 38.71. Now, remember, if this is the multiple choice part of the exam, I guarantee you that choice A is going to be 38.71, choice B is going to be 43.37. So don't make that mistake. All right, moving on to excess earnings. The Institute likes to call this residual earnings. All we're going to do is we're going to start once again with some estimate of earnings. We'll call it normalized earnings from that slide at the beginning of this slide deck. We're going to go ahead and take out, wait a minute, let's think about this. What are we going to take out back here? Let me go back to this, equation. Here we go. Look there. What are we doing? We're going to take out things, right? We're going to take out things like interest expense and depreciation. But look over on the right. Provision for capital expenditures and working capital. So think about this. Free cash flow to the firm, we end with the investment in short-term assets and long-term assets. So what are we doing here? I mean, this is not like we're doing something completely different. We're going to start with that normalized earnings, and we're going to take out the investment in working capital. Now here we're calling it return. You'll see that here in just a second. And then the investment in long-term assets. And so it's the same thing. It's the same concept, but it's applied just a little bit differently. So we're going to call this residual income. Now, somewhere in there, we need to go ahead and figure out what is the value of the intangible assets. And so that's what we're going to do here. So you can look at those two equations at the bottom. So let's do this. Consider the following information. So there's our working capital. There's our fixed assets, right? 45 and 180. So here's our current normalized earnings. So think about that. Year just ended. So the Institute could say that's year zero or currently or some other way to give you that that's going to be the earnings in time period zero. All right, so there we go. Return on working capital 3, return on fixed assets 8. There's the growth rate in the residual 2.5% and a discount rate for intangible assets of 18%. So let's go ahead and work through all the math. Go ahead and look down at the bottom. Let's look at the answer. So we come up with a value of the firm of $260,710. Where does that come from? Well, we were given two of those inputs right away. There's the 45 and there's the 180, right? But then we need to figure out what that other number is. All right, so let's go all the way back up to the top. So the return on working capital, take the 3% times the 45. The return on the fixed assets takes the 8% times the 180. All right, so we got 1350 and 14,400. All right, so what are we going to do? We're going to start with our regular old earnings, right? We're calling that normalized earnings. Take out that return, so minus the 1350, minus the 14,400, and that gets us $5,400. So what are we calling that? We're calling that residual income. Residual meaning what's left over, right? But that's in time period zero. So we need to multiply that by the growth rate of, and what was that, 2.5%, right? Growth rate of residual income. And so note, look in the between the two parallel horizontal lines, we've got 5,400. We're calling that residual income, right? Multiply that by the 1 plus the growth rate in residual income, 2.5%. And then we're going to we're going to divide by the 18%. What were we given that there? Discount rate for intangible assets. Now, there, when you get to the exam, if the Institute gives you that discount rate for intangible assets, go ahead and give them a high five because they're shortening your life. But what the Institute could actually do is give you a whole bunch of stuff for you to compute that discount rate. Subtract out the 2.5%, so you get the 35,710. So what's the value of the firm? You see how this is working. We're calling this, residual income, right? This is this model. So what is it? We're taking, let me go back here. We're taking our 45, we're adding our 180, and then we're making these adjustments to that normalized earnings, the 21,150. So think about this. This is called, what did I say? Excess earnings when we first started this concept. So it's the extra stuff, the extra make something for pennies and sell it for dollars. So that's the 35,710. So just remember that you're using that Myron Gordon dividend discount model in this model as well. That gets us the 35,710, and just add the 45 and the 180 to it. So value of the firm there, $260,000. right, how about this market-based approach? So what are we doing? Observe multiples from comparable or similar companies. So what are the steps? These are probably what you remember back from level 1. Identify a group of comparable public companies. This is really the hard part of all of this. We need to ask ourselves, all right, if we're this bakery here in my city, how do we find bakeries that are publicly traded or that we have data for that have similar size, they have similar operations, they have similar capital structures, they have similar. So that's the difficult one. So I'm guessing what the Institute will do is it will give you a table and say, hey, here are 3 similar companies. All right, derive the pricing multiples, that should be easy. And then adjust the pricing multiples, that should be easy as well. So let's go ahead and work through a quick example here. So we've got market value of debt. We've got normalized earnings. There's 50,400. There's the average multiple of 6. There's a control premium of 13%. There's a discount for increased risk. So the Institute is giving us, some extra information that we had to calculate before, but we don't have to do it now. So what kind of summary can we make down at the bottom of this slide? So the price multiple deflated by 12%. Because of that extra risk. Control premium of 13 is going to be added. Note, look at that bottom one. That's super important. No control premium is going to be added for a non-strategic buyer. So what are the advantages of doing all this? There's lots and lots of information available if these comparable companies are publicly available. What's the disadvantage? Well, picking these companies, that's the big thing that I said earlier. All right, so let's do this at 2 levels. How about if we have a strategic buyer under scenario 1? So all we're going to do is take that risk adjustment. So what was that multiple there? 6, and we're going to multiply that by 88%. So that gets us to 5.3. We're going to compound that 5.3 by the control premium. So that gets us, almost back to 6. We're doing some rounding there. So the value of the firm, take that 6 times the 50,000, we get the 302,000. Take out the market value of the debt of 12,240. So there we have 290,160 for the strategic buyer. And we'll do the same thing down at the bottom. We'll go ahead and ignore the control premium. So you do the math down there, same kind of math, and you get 254,000. So think about this. There's a huge difference between strategic buying and non-strategic buying. What is that? About $40,000. Now, how about guideline transaction methods? We're going to use pricing multiples from the sale of these public companies. And so the adjustments is going to be the difference between the target firm and all of those comparables. Look at that second bullet point there. Most suitable for valuing the controlling interest in a private company. So you have to estimate that control premium. And these are just public filings. And I'll go ahead and warn you that, or give you some kind of history of my life. When I was writing my dissertation, I spent tons and tons of hours in the basement of our library looking up all these public filings in proxy statements. I promise you that was no fun at all. But nowadays, you guys can get that pretty quickly. All right, so how do we identify some of these inputs and how do we approach this? So what's the transaction type? We've already decided that, strategic or non-strategic. What are the industry conditions? We talked about this a little bit ago. This is kind of a macro top-down approach. We need to worry about that control premium so that it doesn't overstate. We also have to worry about understating. The Institute doesn't really address that in the learning module, but overstating. And then are we paying for this strategic transaction with cash, with debt, with a credit card, with a gift certificate, with the lottery tickets? How are we going to do this in there? And then this bottom one here, I love this word. I use this word reasonable as a professor. I use it as a parent, and I use it as a citizen. What sounds reasonable? You listen to our government leaders. Does it sound reasonable? That makes sense. prior transactions, all we're going to do is take a look at what has gone on in the past. What we're going to say is, if we can find a similar firm, and that similar firm to our private firm was sold for 100, well, then it makes sense then that our firm ought to be valued at 100. So that's a meaningful value. That's what the Institute says. But, how often are we going to find that particular transaction for our similarities? All right, how about income-based methods here? We're going to do a lot of stuff that we've done before. Estimate top-down free cash flows to the firm from company information, calculate weighted average cost of capital, estimate growth rate, solve using I always call it the Myron-Gordon growth model, discounted cash flow model, and then make some kind of an adjustment. So think about this. We've talked about all this stuff here. This is addressing the LOS, which in the previous LOSs, we just had to explain, but now we have to calculate. So we're going to go ahead and combine all the stuff that we've done. And we did some calculations previously, but now we're going to do this in a big old problem. Now, the market-based approach, we're going to do the same thing. Choose public comparables, gather and summarize, estimate, and use some kind of an adjustment there. All right, so let's go to the income approach. So what did I tell you? Free cash flow to the firms, the amount of cash available after all expenses have been paid. That's the first part of that. That's EBIT times 1 minus the tax rate, plus the tax impact of depreciation expense, right? So that's the amount of cash remaining after all expenses have been paid. And then we need to worry about after all investments have been made, there's the change in long-term assets and the change in working capital. So there's a good old red boxed formula for you. Calculate weighted average cost of capital. We're going to calculate our weighted average cost of capital. We're going to calculate the industry average, weighted average cost of capital. We're going to calculate public companies that are super similar to ours. I have tons of weighted average cost of capital measurements out there. And then we had to worry about some kind of a growth rate. So this is exactly what we just did in that two-stage model. So we're going to call this enterprise value. So look at the summation. So we're going to have an I equals 1 to n. So think about that right before the plus sign. That was just 2 periods. And then after the plus sign, that was from period 2 all the way out to infinity. So this is exactly like what we've done before. Add a premium or a discount. So let's go ahead and work through an example here. All right, we have an owner of a green tea company, 100% of the shares. All right, so we're an equity analyst. So here we are, we're Vickers. We're tasked with the purchase evaluation on behalf of a client. All right, so what do we know? Jeans, the owner's compensation was $600,000. Ooh, we believe this is in line with the industry average. Debt of, what is that, about $2.5 million with an interest rate of 6%. But here we go. This is what I was saying earlier, which was lower than the ideal debt. So think about ideal debt. Think about that as the optimal capital structure, as we talked about, beginning with Modigliani and Miller, and then adding tax advantages, and then adding financial distress disadvantages. All right. So the reported interest expense didn't accurately represent the optimal cost. All right, so we got to worry about that. So capital structure of 980, increased working capital. What did I say? Capital structure. I'm sorry. So long-term investments, capital expenditure 980, short-term working capital investments 450. All right, so here's an income statement. We have revenues and profits and expenses, and there's our operating income, EBIT, so there's 7,500. There's tax rate, and there we have operating income after tax. So in our next table, we'll take a look at discount rates, and this is exactly what the Institute does in the learning module. I'm going to go ahead and explain some things. Probably editorialize here beyond what I should. All right, so what do we do here? We have the CAPM approach gives us 7.4%. The expanded CAPM gives us 11.3%. The building block model gives us 10.2%. So again, these are substantially different required rates of return on equity. But the Institute doesn't, in the learning module, the Institute doesn't ask you to use those inputs to compute the weighted average cost of capital. What it does is it gives you what we do here in this particular slide. So we have a weighted average cost of capital using the actual debt ratio of 10.2%. Now, we're not told where that 10.2% comes from. Is it the buildup? Is it the CAPM? Is it the expanded CAPM? We don't know that. Now, we could probably use that 6%. Let me go back here. Where were we told? There somewhere. Yeah, we could probably use that 6% of the 2.56 million. We could probably come up with our own estimates. And of course, that's the way the Institute does it. But the Institute then says, let's suppose we use this firm's optimal debt equity ratio, which we don't know what it is. We get a weighted average cost of capital of 9.6%. So you have to be thinking, all right, we're given 5 numbers. What is the number that I'm going to use when I compute the value using this income-based method? And the answer is not any of them. I'm going to go ahead and, was that the Home Alone kid? And he goes like this. I'm going to go ahead and do that as well. Look down at the very bottom. We arrive at a differing weighted average cost of capital estimate of 9.9 for the debt ratios. So I'm guessing the Institute is going to give you that 9.9% because we do it here. The Institute does it on the example inside of the learning module. So that's probably an important thing. Don't worry about all that other stuff. There's the 9.9%. All right, so let's go ahead and develop a base year estimate of the free cash flow to the firm. So we're just going to take some of those numbers up there, plug them into our formula, and we get, what is that, $5.57 million. So that's the base amount. That's the base amount. We're going to have to multiply that by 1 plus the growth rate to get the year 1 free cash flow to the firm. All right, so step 3, we create a 5-year forecast based on a scenario analysis. Oh my God, this is so cool, right? So we've got 3% growth rate in free cash flow over the next 5 years. We've got 5% base case, optimistic case of 7%, sustainable perpetual growth rate of 2%. All right, so you ready for this? Here we go. Down the left-hand column, we have the base year. So notice that's the 5.575 all the way over. So then we have year 1, 2, 3, 4, 5 going down the left-hand column, and then we have a final terminal value. All right, so if the Institute gives you these 3 different scenarios, boy, this is really, really cool stuff. So let's go ahead and look at let's just go ahead and look at the first column. I'm sorry, the third column, the base rate in the orange. So there's the base of 5.57. If that grows by 5% over the next 5 years, then we get 5.8 and 6.1 and 6.4 and 6.7 and 7.1. Okay, so that should make perfect sense. If you do it at 3%, if you do it at 7%, you get the red column and the blue column. But for math purposes, let's just do our base case scenario in that middle column. So what do we have to do? What we need to do is we need to figure out what is that first input to compute the terminal value. What we need is we need the base case scenario in year 6. So we're going to start with the $7.108 million, multiply that by 1.05. So that's going to be our base case year 6 free cash flow to the firm. Look down at the bottom there. We have terminal value, the base case. So free cash flow to the firm, take that 7.1 million times 1.05. That gets us year 6 free cash flow to the firm. What we're going to do is we're going to divide it by, and here we are using our dividend discount model. I always call it the Myron-Gordon growth model. There's that 9.9%. Subtract out the 2%. Let me just go back here quickly. Look at the bottom there. Perpetual, think about that as the sustainable growth rate of 2%. So if we do all that, there our year 6 free cash flow to the firm is the 7464332. Divide that by the 079, we get a terminal value of 94,485,224. All right, so we did all that. Now, if you want to, go ahead and pause the video, and you can go ahead and compute the 84,000 under the 3%, the 105,000 under the 7%. Just use that same methodology that we used for the middle column. I want you to think about what we're doing here. We're computing the value of the firm based on the present value of the free cash flows. So we have that middle column. We're taking the present value of the 5.8 and the 6.1 and the 6.4 and the 6.7 and the 7.1. We're going to add the 94 to the 7.1. What did I say earlier? I want you to think about terminal value as in the following way. We're going to generate 5 years worth of free cash flow. And then as soon as we generate that year 5 free cash flow, we're going to sell the business. And we're going to sell it for $94 million. What is the present value of the 5 free cash flows and the expected selling price of the business? And if you do all that, you get $83,274,310.88 for that base case. We're calling that equity value, right? Now, I'm going to go ahead and pause and refer you to what the Institute does. In this example, in the learning module, the Institute says, hey, let's go ahead and get out our Excel spreadsheet, use the NPV function. And by the way, when you do this in Excel, make sure that you use the decimal form of the interest rate. So make sure you plug in 0.099. And if you do all that, you'll go ahead and get the 83,274 for that base case. Now, of course, you're not going to have Excel during the exam. So what you're going to do is you're going to say cash flow 0 is 0. Cash flow 1 is 5.8 million. Cash flow 2 is 6.1 million. Cash flow 3 is 6.44 million. Cash flow 4 is 6.77 million. Cash flow 5 is, are you ready for this? 7.1 million plus the 94 million. Then you make I 9.9, and when you hit net present value, you'll get the 83,274. Now remember, we're calling that the equity value, right? The value of a private company using the income-based method. So if the Institute asks you for the equity value, you give them the 83. If they ask you for the enterprise value, go ahead and add the 2.56 million to get the 85. All right, so we'll come up with that 83 million or the 85 million. Now we're still not done, right? We need to make some extra adjustments to complete this. So we're given some extra stuff here, right? Lack of marketability concludes that there's a 10% discount for that. So all we're going to do is take 90% of, here, let me go back here. 90% of the 83 million, that gives you the 74 million in the orange. So there we go. Equity value less the discount for the, what was that, 10% marketability. Sure seems like we did a lot of work in that previous example, and the Institute goes to at least a little bit of a length to say something like, you know what, that is a lot of work. It's a little bit easier to use a market-based evaluation if you have that data. And so in lots of cases, this market-based approach is favored over the income-based approach. So let's go ahead and take a look at an example here. Here are the steps down at the bottom. Yeah, choose public companies we talked about. Gather some financial data. Estimate the enterprise value using those multiples. And so I want you to take a look at the take a look at that equation. So enterprise value, it's the summation, right? And there's a weight. All we're going to do is take the weight that is the ratio of what our particular firm looks like over its total sales, the business segment, business line or business segment sales. What we're going to do is we're going to take that weight and multiply it by some kind of a multiple. Well, I'll show you that here in just a second. And then once again, we're going to have to make some kind of an adjustment. All right, so let's look at the bottom here for this example. We've been tasked with analyzing the value of a non-controlling minority interest. All right, so we estimate the unadjusted value is $900 million. Control premium is 10%. Now, this is important down at the bottom here. So we're well known, this company is well known in the logistics industry, but has expanded into parcel and home delivery. All right, so we're going to have a difference in this table that you'll see here in the next slide of things like revenues in the logistics industry versus the other. Yeah, so here it is. So look down that orange column. So we're really good at our logistics service. There's 800. Parcel we're just getting into. Home delivery we're just getting into. So there's our total of 1,000. So we have a lot of assets in the logistics. We've got hardly any assets in home delivery. So it's not surprising that if you look over on the far right column that are, can I just call that operating income? It's a general term for it's general for operating income. So 200, 20, and then a minus 10. So our total is 210. So here's this difficult part. Let me go back here. What was this? Step 1, choose public comparables. All right, so here we go. We've chosen them. We don't have to worry about it. The Institute will probably give us these multiples there. So enterprise value over operating income, enterprise value over revenues or sales. So we see those, and I imagine the Institute would give you these on the exam. So let's go ahead and, let me go back here. What I was telling you earlier about this W, the weight, so let's go ahead and do this. Well, let's just do it with this slide. Look, what's 800 over 1,000? What's 160 over 1,000? What's 40 over 1,000? Well, there you go. So you see the 80%, the 16%, and the 40 and the 4%. And you can do the same for the purple, and you can do the same for the blue to get those weights. Notice that you have a negative weight down on the bottom left. All right, so we have the business line columns that are the bookends. There are the multiples that are from the previous slide. So let's go ahead and figure out what that composite is going to be. So all we're going to do is we're going to take the weights. So 200 over 210 times the 9.4, then the 20 over the 210 times the 8.9, and then the minus 10 over the 210 times the 21.3. So there are the operating income multiples. Let me just go back here. We can go back here to get the, where am I here? Oh, I messed up. All right, so there we go. There's the far right column. That was operating income. I got distracted for a second. So there you go. 200 over 210, 20 over 210, minus 10 over 210, right? So there are the weights, and you do all that math, and you get a composite of 8.786. Do the same thing for the sales. Now, we're going to use different weights, right? Because we have the 80 over the 1,000. So there are the weights, 80, 16, and 4 times the sales multiple of 3.621 and 7.4. So there we get the 3.51. We just computed those composites, 8.786 and 3.512. Let's go ahead and use those to come up with some kind of an estimate of value. All right, so we're going to use that sales multiple. So let me go back here. What is that? So there's our 1,000, and so these are in millions, right? So let's do the 3.512 times the, what is that? That's a billion, right? So there we get the 3.512 billion based on the sales. Let's go ahead and skip down here to the bottom. Let's do the 210. That's just million, right? And that's the earnings. So the 8.786. So that gets us 1.845 billion. So before I tell you about that table here at the top of this slide, so we've done this two ways. We've used the multiples with revenues, and we get 3.5 billion. And we use the multiple for earnings, and we get 1.845 billion. Now, take a look at the table that we have at the top of this slide. There's our revenues in the middle column, right? 800, 160, and 40. If we multiply those by our comparables of the 36, the 21, and the 74, we multiply those and we get the 2880, we get the 336, and we get the 296. If you sum those, you get 3.512 billion. But the important thing here is that not only are we using comparables, but we're going to use those multiples to be able to value each of our business segments. So if we were to sell the logistics service, there we get 2.88, parcel 336, home delivery just 296. All right, so let's go ahead and make those final adjustments here. So what are we told? We've got non-marketability and non-controllability, 15 and 10. So you just can sum those to get 25%. So multiply the 3.5 and the 1.8 by 75%. You get 2.6 and 1.3. And all we're going to do then is take the average of those two. And so there's our market-based result. There we get $2 billion as our single valuation estimate. And by the way, we're dividing by 2 to get an average. And that reminds me of something that I forgot to tell you guys back in this problem. Let me go way, way back here. Boy, I feel so bad that I forgot to say this because this was really in the front of my brain. So look at that bottom sentence where I said differing weighted average cost of capital estimate of 9.9. That is just the average of the 10.2 and the 9.6 that was given in that above table. So I'm glad I remembered to do this. So if you're given this table, make sure that if the institute doesn't give you that 9.9 as part of the question stem, you take the average of those two, which, of course, is what we just did right here to get our $2 billion estimate. And so I believe that takes us through all of those. Boy, let me apologize for keeping you for so long. But boy, there are lots of LOSs here. We had tons and tons of fun stuff to cover. So I sure hope it was worth it. Was that my first 9-hour video? I don't think it was that long. Anyway, so hey, go to those problems at the end of this learning module. I think there are 15 of there. There are 3 vignettes. So you got a 5-question, a 5-question, another 5-question. And you should be able to handle all of those questions. You'll need your calculator for a bunch of those. Now, remember that when you hit those problems at the end of the learning module, you know, some of the stuff that we just didn't cover in here. So make sure you use that as a learning experience because we can't, you know, I'd have a 20-hour recording if I covered every possible question that's out there. So, hey, thanks for watching. Have a great day and good luck studying.